So first of all, I'm not a perma bear. I've always been bearish, always meaning probably since 2007, 6, 7, of the construct of the economy. In other words, an economy that's built on the deformation of interest rates, the creation of asset bubbles, and the taking on of too much debt. That's the foundation built on sand, if you get the imagery there. The allegory. I think that's a good word. Not a perma bear. In fact, I was very bullish last year when we first started talking. I said that the economy was going to do okay and that stocks would go up, and they did. But then I started warning towards the middle of 21. Of course, I was bearish in the start of 2020. I'm just trying to, I'm an active manager, long short strategy. So sometimes I'm bullish, sometimes I'm bearish, and I'm always bullish and bearish in different things. But I did warn 2021 that this year was going to be a poop show, a poop parade. And the reason why I said that back then was because of a stock market that is at the all-time high of valuations. In fact, it's more than 40 percentage points higher than where it was compared to the tech bubble of March 2000.
And can you clarify for people, can you clarify, because they hear on the evening news every night, oh, new all-time high on this index or new all-time high. And that's not what you're talking about. You're talking about valuation compared to what? What's the way that you valuation?
I'm talking about the total. I'm talking about the best metric for measuring the value of the stock market, which is the value of the stock market, total market cap, all right, shares outstanding times price, as a percentage of the underlying economy. It is one metric that you just can't fake by taking on a bunch of debt and buying back your shares and lowering the PE ratio. Price to sales is another metric that's hard to fake, also at a record high. So you're 40 percentage points higher than you were at the apex of March of 2000 for the NASDAQ bubble, right before it dropped by 83%, by the way. So that was predicate number one. Number two is you were coming off a massive fiscal stimuli, which was, as I say, $6 trillion, $50,000 to family. It just ended abruptly. Then you add to that inflation, which if you measured it correctly, would be close to 20%. We can quibble whether it's 15 or 20 or even 25. But if you look at all the most salient metrics of rent appreciation and home price appreciation, we talked a little bit about that in the pre-interview. Look at the cost of beef or the cost of energy. You're about 20% year over year, which is an all-time high in rate of inflation, which is destroying consumers' purchasing power. Then you add onto that spiking interest rates and spiking debt service costs on top of that. Then you add onto that a war in Russia-Ukraine, which is exacerbating the inflation and bottlenecks. Then the COVID-obsessed megalomaniac Chinese government, which is shutting down Shanghai and Shenzhen every time someone sneezes. And those are bottlenecks that are further exacerbating global growth to slow and inflation to stay higher than it normally would be. And then you add on top of that the most hawkish Federal Reserve since Paul Volcker. We have a Federal Reserve that got so far behind the curve, destroying the major constituency for the Democrats, who need to sort of save whatever they can, salvage the midterm elections in November. So you have a Federal Reserve that's absolutely going to trip over themselves in May, June, all the way through November to raise interest rates by 50 basis points and at the same time undergo quantitative tightening. Now, I'm not naive enough to think that the Fed is going to raise interest rates to 3.5% and drain the balance sheet from $9 trillion to $4 trillion. I'm not saying that. What I'm saying is they are going to be forced to aggressively fight inflation until something really breaks in the economy. In other words, until the credit markets freeze over. In other words, until the stock market goes down 30 to 50%. I don't want to, I'm an active manager. This is actually good news. It's good news. Well, Mr. Pento, why, as a Christian and as a supposedly trying to be a good person, why would you say that the stock market going down 30, 50% is good news? Because A, it's actually the healthy thing that the economy needs. You need to have stock prices come back to where the market can support them, not the money printing monkeys at the Federal Reserve. And you have to have home prices come down to a place that can be supported by the free market as well, so that first-time home buyers can afford a house. That's a reason why I'm very happy that this is it's in the process of happening. The bear market has begun. We're in the middle of it, or maybe even in the incipient stages of it, if you want to be exact. And the other reason, B, why I'm not so concerned about it is because I can actually, because I'm an active manager, seek to protect and profit from that grand reconciliation of assets.
Now, you mentioned in passing there real estate. So can we talk about the housing market? Because it's something we've come back to several times. A lot of people were basically locked down in their homes during the COVID period. A lot of people finally made their moves either to a bigger home or a different home, or to a different jurisdiction, frankly, where they could get perhaps more freedom and that sort of thing after the COVID lockdowns were eased. And there was this huge spike in housing sales, housing prices, and so on. Some people have recommended, and you were among the voices expressing caution of people buying, quote unquote, at the top of this market, and saying, look, housing prices are going to be affected together with equity and stock prices if we get a spike in interest rates, et cetera. What's your current outlook for where we are now at in the housing market, and where you see us most likely headed over the next period of time?
So, in complete candor, I bought a house. I'm under contract on a house here in Naples, Florida. I think it's an absolutely stupid thing to do from a financial standpoint, but it's not all about math in this world. Everything is not a financial decision. Sometimes you do things for your family that is not the best for your long-term pocketbook. So I did buy a house. My prediction is that home prices will be about 20% lower year over year from the summer of 22 to summer of 23. I think home prices could drop 20% nationally. All-time record high home price appreciation, all-time record home price to income ratios. The Fed is going to be at least winding down or selling some combination of $2.7 trillion of mortgage-backed securities. Mortgage rates are going to shoot much higher. So I'm bearish on mortgage debt, junk debt, corporate bonds, and I'm starting to become bullish on sovereign bonds, because I think there's going to be a big plunge in economic growth, which will become manifest in the next few months, even to Brian Moynihan. I mean, you could take your advice from me or Brian Moynihan, the CEO of a very big bank, who tells everybody how powerfully strong the economy and consumers are. Well, if that was the case, Mr. Moynihan, I would ask them, why are consumers piling on credit card debt at a record pace? I mean, the increase between January and February was $18 billion in revolving credit. This is the second biggest increase in revolving credit on record. Well, why would a healthy consumer pile on credit card debt, Dunnigan? They wouldn't do that, especially when, those interest rates are, talk about, usury. Those rates are, Shylock rates. So, I would more listen to someone who has an absence of an agenda. Because if Brian Moynihan comes on CNBC and tells you that the economy is in trouble and our consumers are in deep hurt, it's only because he needs the Fed to save his plunging assets. Okay, loans outstanding to the consumer. And if you're going to wait for that, it's going to be way too late.
There's another set of questions around people looking at their existing assets and their retirement funds. And I want to stress what we have, as always on this channel, we're not giving individualized investment advice. We're talking about principles that people should be educating themselves on, be aware of. So One question in two parts from Karen Walker. Where is the safest place to keep retirement funds, even just a bit over 100K, and the best way to protect retirement funds?
Well, yes, as you say in your preamble disclosure, I don't know this client, a potential client, personally, so I can't recommend anything individually to her without doing my due diligence. However, having said that, I made my legal team very happy. I mean, you want to be diversified. If you're not in an actively managed strategy like my inflation, deflation, and economic cycle model, which is a wonderful place for the second best place is a diversified portfolio, which would include cash and precious metals in it. Don't just buy, stocks, because, people often misrepresent how good stocks are as a hedge against inflation. So from the nadir of inflation in 1972, which is about 2.75, all the way through 1980, which was the peak of inflation, around 15%, stocks lost 7% of their value in nominal terms. So it all depends on how strong inflation becomes. And I can make a cogent argument that after this next collapse comes and Jerome Powell is forced to rescue and reliquefy the banking system, even though inflation is still way above 2%, which is their target, you could have a very long and protracted period of stagflation, just like we had in the 70s, but much worse, with soaring yields. And that's a horrible place to, park your money, would be equities in that environment.
So during that kind of an environment, I mean, that's another thing that people are asking about is about what are the costs to the individual of sitting on cash. Your Lies Stop Here says, is there going to be a time when you're heavily weighted in cash, maybe during a crash, and how do you deal with that and the fear of missing out?
Well, I mean, cash I've always thought of as a viable asset class. So, stocks, bonds, commodities, currencies, cash is a wonderful thing to hold. Because, here's the calculation. If the market's going to go down, regardless of the rate of inflation, let's just say inflation is running at 10% per annum. We have a choice. You have your investments, your investment bucket. You could either keep a high level of cash and then just subtract that rate of inflation from it, or you could suffer a steep loss in the principal and then subtract inflation from it. What do you think would be the smarter thing to do? Well, obviously it would be to preserve your principal as best you can in nominal terms. So holding cash is a very good option, sometimes no matter how high inflation is, because your other alternatives just don't work.
There's a related question here, not about cash or stocks, but about annuities. And again, this is not personalized financial advice, but for general principles of people who are sitting on a large investment in annuities, Miranda says, what to do with 500K invested in annuities? No penalty for withdrawal, pay taxes only. What are the trade-offs if I cash out this year and buy precious metals? What are the risks if I wait to cash out to the beginning of next year? Appreciate any thoughts on this comment.
Well, I mean, I don't know when this individual purchased her annuity, but it had to be some time ago, because she's out of that penalty period, usually like a 9-year period of surrender charges. So she's past that. But if she bought it 9 years ago, and I can do that math quickly in my head, interest rates were very, very low. You're talking about, 2011. That's if she bought it then. I don't know for sure, 2011, 2012, 2013, sometime around. She's outside of that surrender charge. So, I would imagine the yield, the promised dividend backed by the insurance company from this annuity is very, very low. And in real terms, it's negative. So if without knowing her, and I can't do my due diligence without knowing everything about her, but, considering cashing in that annuity and diversifying is probably not a bad idea, looking into that option. In fact, I think it's a very good idea. At least evaluate your options.
You've talked to us about the trade-offs of whether and how much to have precious metals represented in your portfolio. And as an active money manager, you're not a perma bear on one thing and a perma bull on anything you you adjust your approach depending on what your leading indicators are telling you is likely to be the trend going forward. So can you give us an update on your latest allocation of precious metals in your model portfolio for your current clients, and if you have an expected direction that you think that will take over the next year?
It's a great question. So I did reach the maximum allocation to precious metals about a month or so ago. I'm now at 18 to 20%, which is my max exposure to the metals and mining sector. It had been working out very well for us outside of today. So I think bear market rallies or counter trend moves are very violent. So you're seeing a big up move in the markets today, sell off in gold and the miners. I still think we're in a big, long bull market. And I think it's just getting started. It will be, here's the caveat, it will be truncated for a very short period of time when and if we reach that liquidity crisis. At some point, maybe in the fall, is my best guess, whenever the Fed decides to really get going with their over $1 trillion per annum of monetary destruction, draining the balance sheet, also known as quantitative tightening. When that gets going in earnest, in conjunction with rate hikes, as that slams into a very weak economy, the chances are very high, in the 90% or above, that we'll have a liquidity crisis. In other words, when the credit markets freeze, and then they just dump everything, and that includes gold. It's just a huge surge or a lurch towards U.S. dollars. Everybody wants them. Everybody needs them. So in that case, gold will sell off. But that'll only usher in the second leg. Let's call it the second leg of a multi-year bull market in precious metals, in my opinion, as the Fed ushers in that long period of stagflation like we've never seen before.
There's a broader question here about, and it's more of a personal reflection, if we could, from you on what we're all facing in terms of our futures. Tim Sandman says, Michael, in 10 years, where do you see the average person's living standards, better or worse, and why?
Very well phrased question. Living standards, standard of living. What is the standard of living? It's the increased purchasing power of the middle class. That's how I define it. The increasing value of your currency and an increase in productivity and an increase in your purchasing power because inflation has been vanquished. That's the reason why I put the cart before the horse. That is the reason why I think living standards are going to fall, because I see a big decline in productivity, and that protracted period of stagflation will erode consumers' purchasing power. That is the reason why I see people moving from the middle class, unfortunately, to the lower class. And by the way, the downfall of any great nation is the hollowing out of its middle class. And that is clearly where we were headed.
Now I'd like to turn the tide around here a little bit. Albert J. says, is all of the negativity regarding the current system inevitable? With so much negativity, can you provide anything positive to look forward to?
Well, there's so many things to. First of all, we just celebrated Easter, so that's something we all should be looking forward to. So, not to give you a sermon here, but to go back to economics, if the Fed were ever to allow this grand reconciliation of asset prices to occur, what a wonderful system we would have on the other side of it. We'd actually tie the monetary base to gold. So the mine supply of gold would equal the increase in the monetary base. And this is all fantasy, by the way. I'm hoping you asked me to fantasize on that. But I'm going to fantasize about a Federal Reserve that goes back to tying the dollar to specie. We have a very limited monetary base. Asset bubbles are no longer in existence. We don't resort towards universal basic income. We no longer monetize massive trillions of dollars of treasury debt. And we have a stable dollar, stable rate of inflation, low taxes, low interest rates. That is something that would be a product of going back